What if you didn't have to sell your shares? What if you didn't have to sell anything in order to buy Bitcoin? As far as the total addressable market for this specific product goes, it's $34.5 trillion. And so this is the single biggest asset class in the world. Real estate relative to Bitcoin, or Bitcoin relative to real estate, has grown 14x in just 6 years. We think that is the single biggest opportunity for Bitcoin and for homeowners over the next several years, but also for construction companies and investment managers who are managing these REITs. These dual collateral products will be a huge hit. You can insulate yourselves when your homes are not selling. It essentially offers an insurance policy. I've already seen this validated in the market. Grant Cardone's Bitcoin and real estate. It's been hugely successful. The next player to try and experiment with something like this will bring this open to the public. That is a generational opportunity right there.
ARCHIE.
Our customers were coming to us and asking us for different methods of posting their Bitcoin as collateral to acquire financing against it. And in self-custody in its current form, and really, so the idea of self-custody is to basically hold that Bitcoin for the long term, not put it at risk at all. And acquiring yield on that Bitcoin, or acquiring cash for that Bitcoin is kind of in a way antithetical to the idea of self-custody. And so we tabled that idea, but we did take that customer feedback and explore options of integrating Bitcoin with traditional finance, right? Integrating Bitcoin and potentially using it as collateral. And one of the things that we stumbled on is actually the inverse of that, right? Using other assets as collateral in order to acquire more Bitcoin in a low risk fashion, right? In a low or no price liquidation risk fashion. And we stumbled upon home equity sharing agreements. Home equity sharing agreements traditionally, in practice, what they allow you to do is you're a homeowner, you're sitting on a decent amount of equity. Let's say you're in your 30s, 40s, or 50s. You're going to be in your house for a while, but you want to do a home improvement project. Traditionally, the way that they've been used is to acquire cash for your home without new debt, without monthly payments, without interest charges in order to, let's say, redo your floors, right? It's a very short-term thing. You pay it back, in relatively short order. And that's usually how these things have existed for a very long time. You don't foot the bill on monthly payments, but you can do these, projects around the house that you've been wanting to do for a while. We looked at them as a unique and novel method of acquiring cash in order to purchase Bitcoin, which is something that nobody had done before. There were a couple of different options in the market at the time that we began ideating on this that allowed for something similar. To acquire financing against your home in order to go and buy Bitcoin. Many of them were reverse mortgages or deferred interest loans. So they did carry interest. Some of them did carry monthly payments. But ours was fundamentally different because it didn't carry any of those things. And so, the light bulb really went off when we realized, this is not utilized for investment purposes to this point. Why is that? And also, Bitcoin is an asset that everyone believes in. Everybody wants to acquire more of it. The whole meme is, I'm going to sell my shares and go buy some Bitcoin, right? But what if you didn't have to sell your shares? What if you didn't have to sell anything in order to buy Bitcoin? What if you could take this mountain of equity that you've built up and what your home is worth now and leverage that and go acquire more Bitcoin in a low or no price liquidation risk fashion? And really, that's the window that was opened up with home equity sharing agreements. And so we worked essentially from last June or July when this idea initially came to us, all the way until May when we launched the first product. We announced it a little bit earlier, February or March of this year, and then we launched it in May. We worked really tirelessly to acquire funding partners, to get this thing to market, to build out a front end, to build out a back end process of getting these things done. And then we launched it. Currently, it's a Thea product. It might not be for very much longer, but essentially it exists within that stack, right? That kind of Bitcoin ownership and accumulation stack, financial services. The entire team that's behind Thea is also behind Horizon. On the one end, you can custody your Bitcoin holdings in a safe and secure manner that really doesn't take any technical ability to do, any major technical ability to do. And we're very proud of that. And then on the other end, for homeowners who want to acquire more Bitcoin, we've built a very novel and seamless and efficient way, a process that allows them to purchase more Bitcoin. And so that's how, the Thea idea initially came to the team. I was brought on board shortly after that V1 of the Thea product came to market. And since then, we've been building not only that stack out, but then the Horizon stack out. And now what you have is kind of a Bitcoin accumulation engine on one side and then a Bitcoin preservation machine on the other. And that's kind of the Thea and Horizon story to date.
So what's the target market of assets in the housing sort of pool that you're looking to address, and what is the incremental flows or potential incremental flows into Bitcoin as a result of this kind of product or products similar to it?
So I did a research piece. It's called The Great Repricing, and I released this back in August. I was kind of on a crunch to release it because I wanted to have it as fleshed out as possible, but I also wanted to get it live before I went off and got married and went on my honeymoon. Because this was just a pretty hectic summer that I've had. But I wound up publishing this in August, and essentially talking about the total target market. I went ahead and did all the math, and I quantified that the global real estate market in total is about $370 trillion. That number comes from Jesse Myers over at Smarter Web Company currently. At the time, I'm not sure he was, but he's kind of been famous for talking about Bitcoin in relation to other major global macro asset classes. And he calculated global real estate at about $370 trillion. In the United States, residential real estate is about $60 trillion. It's at an all-time high. Actually, I just published a couple of days ago, actually, it's $55.2 trillion. That's the total value of the U.S. housing market. And within that, there's about $34.5 trillion worth of home equity. And so as far as the total addressable market for this specific product goes, it's $34.5 trillion. And so that's a major market. When you compare it to other asset classes out there, we'll go global. You take a look at things like equities, which are $135 trillion. Bonds are $318 trillion. Money in general is $129 trillion. Art and collectibles is 27 trillion. Gold is 23 trillion. Real estate is $370 trillion in size. And so this is the single biggest asset class in the world. And it's the single biggest asset class in the United States. If you just ignore all of the derivatives and you just look at the notional value of these things, real estate is the single largest asset class in the world and in the United States. And so I went ahead and calculated the intrinsic value of real estate. I calculated what the bricks and mortar and the value of the land is versus, and then I compared that to what the market value of it was. And I calculated that based on if you were to tear down a home and rebuild it today, what the replacement cost would be. And of that $55.1 trillion worth of U.S. residential real estate, about $33.3 trillion of it was actual bricks and mortar and land value. And the remainder of it, right, some, close to 30% of it, or actually over 30% of it, was pure monetary premium, right? This premium that existed on top of the actual brick and mortar and land value of these properties. And so that's the total addressable market. And then within that, there's this monetary premium that's baked in, which is essentially monetary capital has bought homes in order to use them as investments when they were never intended to be investments at all, right? All they should serve as is a utility. And this is further corroborated. This idea of homes shifting from a utility asset to a monetary asset is validated by some survey data that was recently published. If you go ahead and look at a survey that was published by Clever Offers, they've gone ahead and found that of the boomer generation, right, the generation that has the largest percentage of U.S. residential real estate wealth, if you exclude private equity, over 60% of them have said that their home is their greatest financial achievement. Right? Think about that. Their home, which is simply a place to live, is considered a financial achievement. Moreover, about 60% of the average American's retirement portfolio is in their house. And so ultimately, this has become a financial asset when it was never intended to be one. And another startling statistic is that nearly 3/4 of them plan on never selling their house, right? So essentially what you have here is housing has become a financial asset, whether people choose to believe it or not. That was exacerbated in 2008 when instead of allowing these banks to fail, the Fed came in and saved the banks and essentially ensured that's when homes became a politically protected asset, essentially an asset that the Fed makes sure the price of them never goes down. And as a result of that, home values, the total value of the U.S. real estate market has never been higher, and it will never be in a state of secular decline. The residential real estate market, the commercial real estate market is kind of folding now, but as far as the residential real estate market is concerned, it's a politically protected asset class that's never going to decline in value. And so when we think about the biggest opportunities for Bitcoin, you talk about incremental flows into Bitcoin. In my mind, the biggest opportunity for new Bitcoin buyers and incremental Bitcoin flows comes from U.S. home equity. It's this market that's huge, and it's only going to get huger. The Fed is now cutting interest rates. Obviously, the market has had a bit of a wobbly reaction to that, and we'll talk about that as well. But in my mind, because real estate's a politically protected asset class, as they've demonstrated 3 times now, right, in 2008, 2020, and 2022, they've demonstrated that at every single turn, when there's a threat to the housing market, they always come in and prop it up. Same thing goes for the S&P 500, frankly, because it's a big market and it's only going to get bigger over time. Really, that is, and it's larger than the equities market. It is the single biggest opportunity for new Bitcoin buyers. And so really what we want to do is build the tools for the capital to flow from one into the other. Talking about incremental flows, right? That would be, kind of back of the napkin math. But what I can say is that even if you assume, let's say 5% of the total value of U.S. residential real estate would move into Bitcoin, 5% would be basically the larger than the size right now of Bitcoin as an asset, right? $55.1 trillion, 5% of that is roughly around, $2.5 trillion ish. And that's bigger than Bitcoin is right now. It's like $2.34 trillion. It's 112, I think, behind me.
What about as a multiple of the amount of capital that's already moved into Bitcoin? Is that around about $1 trillion already?
Correct. Yeah. So real estate relative to Bitcoin, or Bitcoin relative to real estate, has grown 14x. So global real estate in 2019, Bitcoin was only 0.04% of that. Now in 2025, as of, I think, last 2 weeks ago when I calculated this, it's 0.6% of global real estate. So that's a 14-fold increase in just 6 years. So already some capital has flown from real estate into Bitcoin from people directly divesting. But what we're more interested in is siphoning that capital without having to have people sell their homes, right? We think that is the single biggest opportunity for Bitcoin and for homeowners over the next several years and several decades, is essentially mobilizing their home equity, an asset that over the last year, national average is 1.65% in major metro areas. It's been more than that in terms of growth, less than 2% growth, into an asset that over the last year is up 99%. Right. That's the single biggest opportunity in our minds for homeowners, but also thinking about Bitcoin as an asset. If you take the total addressable market for residential real estate and you say, okay, what if 5% went into Bitcoin? What if 10% went into Bitcoin? What if these private equity firms sold their real estate holdings and decided to buy an asset that was doing much better? They decided to essentially transform physical capital into digital capital, right? Michael Saylor talks about this. That is a generational opportunity right there, not just for Bitcoin holders, but for homeowners to capitalize on that shift. It's a shift that's already underway. The conversation has shifted massively from where it was previously, these institutional inflows, to talking about real estate as an asset that people can outright sell or swap from one into the other. And we believe we're really leading that charge with this product.
Is there potential for real estate investment trusts to also, offer or engage in a similar kind of product where they're using their real estate portfolio to buy more Bitcoin as well? I mean, it doesn't really make sense if you're a real estate company to do that. I mean, you're involved in real estate, right? But if you look at it from an investment portfolio management perspective, where you're just trying to get the best possible return, it does make sense to do that. Do you think there's scope for that industry to come into Bitcoin?
I think so. I think as an investment manager, maybe working in a company that is offering real estate investment trusts, it may be prudent to maybe hold 2% of your capital in Bitcoin, maybe even 4 or 5% of your capital in Bitcoin, purely from the standpoint of protecting yourself, right? Right now, real estate investment trusts are offering between 5 and 7% in annual dividends to the holders of these REITs, paid out monthly or quarterly or semi-annually. And right now, existing homes are selling for a premium over new homes. Why is that? That's because these companies who are building homes at such overinflated values are having a lot of trouble selling these things. And so they're marking down their prices. Why are they marking down their prices? Because they have construction debt and they need to move on from one build to the next build. And they're willing to foot a smaller margin or even foot the bill on a loss than not sell these things, right? They have a lot of debt on one side of the equation. On the other side of the equation, they have homes that are not selling. And so they're forced to sell them at a smaller for a lower price. And so I view Bitcoin from the homeowner's perspective as huge, but also for construction companies and investment managers who are managing these REITs as a pretty big opportunity. Because even though it isn't a cash flowing asset, it's an asset that you could use to protect yourself in times such as these, when your homes are not selling, and it becomes increasingly difficult to either work within the confines of what your existing construction debt allows, or pay the dividends on your real estate investment trusts. And so I think for real estate, for REIT investors, Bitcoin offers a pretty unique opportunity. You're not getting paid dividends that you can then go and reinvest. But what you are getting is an asset that's appreciating by 100% a year for the last 2 years, if not more, and at the very least has done 25% over a multi-year time frame. The lowest Bitcoin's 4-year CAGR has ever been. If you take a look at its 4-year CAGR, it's 25%, right? That's the lowest that it's ever been. And so ultimately, for the people who are offering these trusts, it essentially offers an insurance policy in times like this. Instead of having to rely on banks to come and bail you out, or saying, hey, look, we can't do that, 5% dividend. We can do a 3% dividend or a 3.5% dividend. And that causes massive outflows from your trust. What you might be able to do is kind of offer a dual collateral structure where this instrument is collateralized 80% by real estate properties and 20% by Bitcoin. And then in doing so, you can offer a tremendously higher yield, right? Even with just a 20% Bitcoin component, your REIT can go from 5% to maybe even 11 or 12%. And also you're ensuring that in times of crisis, in times where your homes are not selling or they're not cash flowing as much as you'd like, particularly for commercial REITs, my goodness, the vacancies have never been higher in major US metro areas. You can insulate yourselves in times like that, prevent outflows, and make it so that on the margin, you have a REIT, you have a structured real estate financial product that's outperforming others. And it can really save a lot of these companies that are operating on really thin margins and potentially foreclosing from doing so if they just blend a little bit of Bitcoin into it. So I think that real estate backed Bitcoin financial products, or I'll say like a blend of the two, these dual collateral products, will be a huge hit once they start coming to market, because it offers a better yield for the investor on the margin. And it also makes it so that even construction companies who have to sell their homes at a loss don't have to do that anymore. They can keep their homes exactly where they are and know that they have an asset on their balance sheet that's appreciating and doing quite well, so they can weather these storms that we're experiencing a little bit better. I think Bitcoin has the potential to fundamentally change the way that structured real estate finance works. And as far as real estate investment trusts go, I think that it's a no-brainer to do. We've already seen this validated in the market. Grant Cardone's Bitcoin and real estate hybrid trusts, building these multifamily places and these commercial properties. I believe it's mostly multifamily. It's been hugely successful, extremely successful. He was able to sell that thing very quickly. And so the integration of Bitcoin and real estate is an idea whose time has come, and the market has voted on that. And so now it's on financial institutions in the United States to create these products and satisfy the demand, both to the benefit of real estate companies, but also to the benefit of Bitcoin as an asset.
So I just wonder how that would work. Would that be on a project by project basis, or is this going to have to be a long dated fund that would at least ride out what we've seen Bitcoin cycles endure, so a minimum of 4 or 5 years? I know Saylor's, when he was raising debt, it was 5, 6, 7 years. So how would a real estate company manage the Bitcoin cycle in addition to what they're having to manage within the property market? Because property is also a cyclical business as well.
Extremely well said. These would have to be long dated instruments, right? You're looking at 10 years plus. You saw the initial success of Saylor's convertible notes. Those were 10-year notes, right? Those were 10-year instruments, essentially borrowing at literally 0%, oversubscribed, and then saying, hey, I'll pay you back with 0% money in 10 years. It's essentially a bet that, Bitcoin will do more than zero over 10 years. And so essentially real estate would need to operate in the exact same way. These hybrid Bitcoin and real estate vehicles, the initial version of them, I think, would need to be long dated, right? So you need to be locking people in for 10 years, either through a note or even something like a preferred stock, right? If a public company wanted to go ahead and test the waters on this thing. Not just to manage the Bitcoin cycles, but as you said, property is also a cyclical business. And then it becomes a question on the investor relations side. How do you market a vehicle where people need to lock up their capital for 10 years, right? And the thing that I would say about that is that sovereign debt right now, I have the Bloomberg terminal pulled up, if you lock your money up for 10 years with the US government, you're getting 4.12%. The value prop for this type of vehicle, let's say an 80% real estate, 20% Bitcoin vehicle, would be that, okay, with even a high yield corporate debt or middle of the road investment grade corporate debt, you can get 200 basis points on the 10-year US Treasury to 600 basis points on the 10-year US Treasury. Throwing in 20% Bitcoin and 80% real estate, that could bring you up to maybe even 15, 16, 18, 20%. And that can be something that's promised over 10 years, right? So that's how I would think it would need to be done, because you need to manage around real estate cyclicality and also Bitcoin cyclicality, creating long dated instruments that would allow you to weather the storm of Bitcoin cycles and also real estate cycles. And so really to this point, we've only seen closed end funds do this, like Gary Cardone's fund. I think the next player to try and experiment with something like this will bring this open to the public, right? Institutional investors at first. I think that's the next way that you do this. You create a 10-year structured note for institutional investors. You do a roadshow about it. You explain the product mechanics. You raise, let's say, $10 billion, $50 billion for this type of instrument, probably $10 billion to start. And then that really serves as the minimum viable product for this thing. Once the news gets out that is an extremely oversubscribed instrument, because you're catering to a much more risk averse portion of the market, then more people try and do this thing, right? In the same way that when Sailor's convertible notes were oversubscribed at 0%, a lot of companies woke up and said, whoa, like this seems to be a really successful way of raising capital to strengthen our balance sheet with Bitcoin. I think in the same way, you probably see a player or two try out this type of, maybe 10-year, maybe 5-year convertible note that's backed by both Bitcoin and real estate, guaranteeing, 15 to 20% annual coupon rather, as far as convertible notes go. And then from there, should that be oversubscribed, that's telling you that the market has an appetite for this thing. And then more companies decide to do it.